This lecture will cover trading the news. So the outline for this lecture will cover introduction to the news, the dangers of trading the news, NFPs, which stands for non-farm payrolls, and how to trade the news. So consider a scenario. Assume that you had 100 shares of a software company stock. Recall in one of my earlier videos, we said that shares represent a unit of ownership of a company. Well, assume that we had 100 shares of a company's stock. So in this example, we assume the company is a software company. Then assume that we saw in the news that the company just filed for bankruptcy. In simplistic terms, what this means is that the company, maybe it don't have sufficient funds to meet its short-term and long-term financial obligations. And as a result of which, it would have gone to, let's say, whoever is the authority that registers business. Well, in Trinidad and Tobago, that will be like Ministry of Legal Affairs. So it go on to a public authority and it's filed for bankruptcy because it's unable to fulfill its debt obligations. So in the case where you heard this news, what would you do? Would you want to keep the stocks of that company? How do you think other people would react? Well, I could tell you what I'll do. If I heard that I had shares of a company and that company has filed for bankruptcy, the company doesn't have enough money to cover its financial obligations, I would sell the shares of that company. I don't want that stock at all. I would try to get rid of that stock. Most likely, other traders will have that same opinion or that same viewpoint, in the sense that if they get negative news regarding the shares of a company, they will try to sell that stock to get that stock off the hand. Because think about it. If it is now the company gone bankrupt, then the company will not have sufficient money to pay dividends. So if it is you're holding that stock as an income stock with the objective of earning a dividend every quarter or every biannually or annually, however they pay that dividends, that would automatically mean that you will not get dividends. And negative news can cause the price of the asset to decline. How to cause the price of the asset to decline? People start to sell the asset, and when people start to sell the asset, the price will change. So let me show you how this will look. Let me draw a diagram and show you how this will look. So I will draw my demand and supply curves. So basically what I want to do is draw my demand and supply curves, because trading news is essentially, trading on news is basically fundamental analysis. So this is the demand curve. This is the supply curve. And then assume that some bad news came out with the company. Let's say the bad news was the company went bankrupt. When this news comes out, this will send like a negative signal to speculators. It will send a negative signal to retail traders and even to investors, because investors own the stock and they interested in earning income from holding the stock. So basically what happens is that when there's bad news, this would send a negative signal to different stakeholders and they would try to sell the stock. When they sell the stock, the demand for that stock will decline. So the demand will shift from D1 to D2. So the demand will shift from D1 to D2. So this will be a new demand curve. When that occurs, what happens to price? Well, we can see here, this was previously the original equilibrium price and the equilibrium quantity. The price will now decline. There will be a movement and the price will now decline from PE1 to PE2. This is what happens here. So when there's bad news released about the company, the bad news will send a negative signal to investors, to send a negative signal to retail traders. It will send a negative signal to speculators. Basically, this negative news will cause a demand to decline. They will start to sell the stock. When demand declines, there will be a backward shift in demand. It will shift from D1 to D2. When it shifts from D1 to D2, equilibrium price will decline from PE1 to PE2. Basically, what this shows is that there will be a decline in the price of the asset. So, share my screen. There will be a decline in the price of the asset. Now, if I'm a trader or if I'm an investor and I hold in this stock and I realize that the stock is declining, the price is declining, I don't want to hold the stock. I want to get rid of the stock. So that even self, when the price declines, even more people will start to sell the stock because they realize that, hey, I don't want to experience a decline in the price. So decline in the price of the stock will cause more people to sell the stock, and that in turn will even cause the price decline even further. So this will cause a lot of speculation. Speculation is where the price of the asset may react. There might be a big price reaction, and it might even be the small news, But the whole fact is that so many people are reacting to this news at a period in time that there might be a big change in the price of the asset. So when news comes out, there could be a big drop, big decline in the price of the asset if it's bad news. Now, if you had sold, if you had, let's say you had received the news from beforehand, let's say you received the news, bad news about the company, like about a day before or 2 days before, and in anticipation of the news, after you analyze the news, you decide to sell that stock. And when you sell that stock, you go short, you sell the stock, you make a profit of the change in the price of the stock, and essentially made a lot of money. Now I say they make a profit. Now I say they're going short, you're short selling stock. Mind you, this is a practice that cannot be implemented in some exchanges, like let's say the TTSC. In Trinidad and Tobago, the stock exchange, the TTSC, does not allow traders to short sell. Short selling is where a retail trader sells the stock first and then buys back after. So normally you would accustomed to, let's say you're interested in an asset, you'll buy the asset first, hold it, and then when you fed up with the asset, or when it doesn't really meet your objectives, you will sell the asset. Well, you can do the reverse, where you can sell an asset first and then buy it back. Now, this practice is implemented in many international financial markets. However, in Trinidad and Tobago, this practice is not allowed. Now, in the stock market, when you hear news before everyone else, if you take profitable trades, this practice would be illegal. However, in the forex market, well, I have here, it's called fair game. But what I really want to say is that in the forex market, this is allowed. You see, in the stock market, it is possible for any one company to manipulate the stock or its own stock price, or it is possible for executives in a company to manipulate the stock price. However, in the forex market, because of the wide volume of currencies and amount of money moving at any given period of time, it is difficult for any one person to manipulate the forex market. Mind you, I'm not saying that manipulations don't exist. They can occur and they do occur from time to time. However, in the stock market, when one person tries to, let's say, engage in insider trading and buy and sell an asset or the stock to make a profit based on information that they receive beforehand, before everyone else, this will be illegal. This will be something that will be frowned upon. However, in the case of forex, if it is you receive news, let's say you might read some central bank report before anyone else, and you trade the forex market and you make a profit. This is allowed. Nothing is wrong with that. So the point I want to emphasize here is that the forex market moves based on news. Now, as we saw previously in many previous videos, there's technical analysis, there's fundamental analysis. Technical analysis focus on charts. We look at charts, chart patterns, look at trends, we look at indicators, and we try to estimate or try to forecast, even say forecast, what the price of the asset will go to at the next point in time or within a relatively short period of time. Now, with fundamental analysis, we look at macroeconomic factors and macroeconomic, political, and different, even social factors and how they might affect the price of the asset. Well, in this case, the asset here we're looking at is the forex, the foreign exchange. We look at how it might affect the price of the currency pair and how it might change over time. So as forex traders, it is important to pay attention to different news sources. So I have here major economics bulletins, central bank economics reports, speeches on the economy from government officials, because be realistic, the first person to know if our economy is going up or going down should be the government, because the government, they should have their statistical authorities, and the statistical authorities will be able to compute what is the GDP, they'll be able to determine what is international trade, the exports, the imports, and so forth. So they should be the first to know if the economy is performing well. Mind you, our government, now I am not saying this, I'm not trying to support or discredit any government. I'm just saying that they're supposed to know, based on their collection of information, if their economy is performing well or not. Mind you, some governments may know the truth about how the economy is performing, and they might put out news releases, or they might say in speeches that, yeah, the economy is performing well and so forth. But when you look at the unbiased reports, like the central bank reports, the economic bulletins and so forth, these give an accurate depiction about the performance of the economy. So if it is you understand economics and you can see these reports and read these reports and understand them, you can determine that this economy is performing well or it is performing bad. And if the economy is performing well, generally, this will cause the forex price, the price of the currency pair, to appreciate or go up or experience a rise in value. Likewise, if the economy is performing bad, there should be a decline in the value of the currency pair. Well, that country's currency in relation to the next country's currency. So I mentioned here, your goal as a news trader is to get in the correct side of the move, meaning this, that sometimes you trade the news and you mightn't get the correct entry position. But because the movement tends to be strong, a lot of the time when there's good news, there's very strong, good movement. Even if you don't have the best entry position, there will still be a lot of opportunities for you to earn a profit. Hence the reason why I say that your objective is to read the news, determine the correct direction. And once you're in the correct direction, it's just up to you to milk and pick off the profits. Now, yes, news is good, but at the same point in time, there's risk concerning news. And now, when news occur, a number of different things occur also with the forex market. First, begin with spreads widened. Now, the spread, what is the spread? Now, the spread I'm referring to here is the bid-ask spread. So you buy here at the ask price. This would be the ask price. The green would be the ask price, and the sell would be the bid price. This is the bid price. Now, anytime a retail trader wants to, let's say, they want to buy an asset, that means someone needs to have the assets and they want to sell it back to you. So this is what they'll be asking for. They'll be asking, so in this case here, this currency pair, they were asking for 1.2460. This was the ask price. Likewise, if it is now somebody else wants to buy the asset, but this is what they're bidding, this would be the bid price. So let me actually type it in here, the bid and the ask price, so it'll be easier for you to follow. So you buy at the ask price. So this is what traders who have the asset want you to pay for them to sell the asset to you. So you buy here at the ask price. The green price here will be the ask price. Likewise, you're going to sell at the bid price. So if you have the asset and you want to sell the asset, this is what the people who want to buy the asset, this is what they want to pay. Now, there's always a gap between the ask price and the bid price. This is the bid-ask spread. Now, there will always be a bid-ask spread because this is one of the ways the broker can make some money by allowing you to trade on the market. Now, when news is released regarding economic events, this can cause the spread of the forex, many currency pairs, to become wider. Now, the widening of the spreads is bad for the trader because it will increase the cost of trading. Basically, what happens if you want to buy the asset instantly, you want to buy the asset and you want to sell the asset at market. If you buy it at 60 and you sell it back instantly at 58, you will have a cost of 2 pips. You will lose roughly 2 pips on this trade here. However, if you buy the asset instantly and you sell the asset instantly, what happens? You will lose 20 pips. So this will increase the cost of trading. This will be an increase in the cost of trading for the retail trader. It can also lead to a thing called slippage. Slippage is when you want to execute the order at a particular price, but when the order actually gets filled, it occurs at a price that you don't really want or don't really like. Take, for instance, let me give you an example. Assume you wanted to sell, let's say, oil. You wanted to sell oil at $60, and then there was a wide spread, and when you wanted to sell oil at $60, oil ended up dropping from $60 to, let's say, about $52. So there was a wide spread, a wide slippage. Now, that's just a random example, but the slippage for oil might be this amount. This is one of the problems of when you're trading the market based on news. So you might fill an order, yes, but the order don't get filled at your price or the price that you desire. There might be a big drop in the price of the asset, and there might be slippage. This is a problem because if you was anticipating to sell the oil, I just use this example here. If you was anticipating to sell the oil, let's say at $60, and you was anticipating the oil to drop to about $50, then if the oil order get filled at actually $52, then all you can make is $2 off the drop in oil because you lost $8 right there because slippage just occurred. In other words, because of the market is reacting to news, there was a big drop and you losing out on your opportunity to make as much profit as you would like to make. This happens when the market is trading on news. So our next thing can also occur is where the trader becomes locked out. Basically, that means that you want to enter a trade, but you cannot place the trade like when you want. So you might want to buy the asset now. So I just use an example. You might want to buy silver right about now. Assume silver is trading up, going up based on some news, and you want to buy silver right now, but you can't buy silver because temporarily the market has been some freeze on the market. There has been a stock halt, and you get locked out. So which means that you want to enter a trade and you can't enter the trade. Let's say the the stop halt was only for about 5 minutes. So you actually get to implement your order about, let's say, about 5 minutes after you want to actually implement your order. So because it gets locked out, a slippage, or well, in that case, wouldn't be a slippage, that would be a jump. There will be a significant increase in the price of the asset. In this example here. But the whole point is that the order doesn't get filled at the price that you want, and it wouldn't make as much profit as you would like. And next thing could happen when the market is trading on news is that there's a lot of whipsaw behavior, whipsaw, up and down, fluctuation. So let me see, share my screen. Screen share, new share. So I'm assuming that you can see this. So when I'm saying whipsaw, I mean this. It means that the market could be going up strongly. There's one big movement up, and then there's a strong movement down. So you might think that, hey, the market is going down, so I'll go short, I'll sell the market. And at the same point in time, market will go right back up again. So you might say the market changed, the market now going back up, the market is coming bullish, then it go right back down again. So you want to know what's happening, why all this volatility, why all this fluctuation in price of the asset. Usually when you see this kind of rapid behavior, rapid changes in the price of the asset up and down, this is because the market is reacting to news. Something has happened and the market is reacting to that. And back to my PowerPoint. So it is possible to trade the news, but we have to know what news are worth trading. So we have to know what news are worth trading. So these are different economic events or different news releases that are important and that can affect the price of assets. They can affect the price of stocks. They can affect the price of, let's say, currency pairs, and they might even affect the price of commodities. But in this context here, we're looking at forex. We're looking at what could affect the price of forex. What are the news events or news reports that can affect the price of forex or different currency pairs? So we can have changes in the central bank policy. Now, central bank is the authority that has an economic policy instrument called monetary policy. What monetary policy is, it allows the bank to use, well, the central bank to use various tools, such as open market operations, that's the buying and selling of securities. You can have seigniorage, this is where they print currency. You can have instances where the central bank can manipulate the interest rate. This can be done by manipulating the prime rate, or you can also see it occur where the central bank manipulates the reserve requirement ratio. The reserve requirement ratio is where every time, let's say, a bank has someone makes a deposit in a bank, the commercial bank needs to retain some proportion of that deposit in the central bank. So if the reserve requirement ratio, let's say it was 10%, then every $100 that someone deposits in the bank, $10 must go in the central bank to hold as reserve as like a precautionary measure, and the bank can use $90, which is 90% of that $100, to facilitate or to distribute loans. If it is the central bank increase the reserve requirement ratio, let's say from 10% to 20%, then what this means is that the commercial bank can now only use $80 to distribute or facilitate loans as opposed to $90. What this means is that if the central bank manipulates the reserve requirement ratio, there will now be less credit available for people willing to take loans on a domestic market. So this is one of the policy of the central bank, monetary policy. A next policy that could cause a change in the foreign exchange or forex or currency pair is called government policy. Government policy is fiscal policy. Fiscal policy is where the government uses its tools of government expenditure and government taxes to more or less achieve its fiscal objectives. So if it is the economy is doing bad, the government can increase its expenditure. This is called expansionary fiscal policy, and this can cause an increase in economic activity in the economy through a thing called the multiplier effect. I'll explain that in detail in my economics lectures, but for the context here, you just need to know that government can spend more money, and if the government spend more money, this can cause the economy to improve, the economy can go up, and if the economy can go up, this can cause, it has the potential to cause the foreign exchange or the currency pair of that country to appreciate or go up in value. A next thing that can cause changes in the price of forex is economic data releases. So this would be, let's say, economic reports from, let's say, the European Union, the US economy, the IMF, the IDB. If these different international institutions release economic data and these news releases, these economic data releases are not in accordance with what is expected, meaning that it's better than before, then it can cause many countries' currencies to go up or appreciate. If it's worse than expected, it can cause many countries' currency to go down or depreciate. And I have here a next thing that can affect the price of forex is the random tweets of world leaders. And this might sound far-fetched, but for a period of time, let's say so this year is 2021. Let's say we go back to for the period 2016 to like 2020. I mean, some world leaders would put out certain tweets, and this will cause the price of certain assets to go up or go down. Now, I'm not going to call any world leaders names. I'm not going to talk about any, I'm not going to call any countries, but this is possible, and this was actually taking place. We see certain world leaders make certain comments, political comments, and instantly the price of different assets start to react, they start to go up and start to go down. So these are the economic variables here that may impact the price of forex. So you have the interest rates, decisions by the central bank. You have the inflation. So I have inflation. This can be measured by the consumer price index, the producer price index, and so forth. We have the employment data. So we could look at, let's say, the unemployment rate. We could look at labor force participation. We could look at wage growth and so forth. We could look at economic growth. How we measure economic growth is by changes in the GDP. So there's the real GDP, which is GDP adjusted to inflation. There's the nominal GDP, which is GDP that is not adjusted to inflation. There's the per capita income. That's where we take, let's say, a GDP statistic and divide by the population and so forth. We have retail sales. This is a measure of commerce in a country. So retail sales. So what is the retail? Who are the retailers? So retailers, we have wholesalers who are large-scale collectors of various goods, and they distribute it to retailers who in terms have like different distribution and department stores and so forth. So a retailer might collect a wide variety of goods. Now, I'm from a country called Trinidad and Tobago, and in my country, we import a lot of consumer goods. So a retailer in Trinidad and Tobago will import a wide variety of goods, and then they will sell and distribute these goods to various consumers in Trinidad. So they may supply to, let's say, even small stores, small shops, and so forth, but they import a lot of goods and they distribute the goods. They have the distribution networks to distribute the goods to various stakeholders, economic agents that are interested in selling the different goods to make a profit. You have industrial production. So that's economic activity again. So we can have here, what are your factories doing? Is there an increase in the output of your factories? Are they producing more goods and more services? We can have business sentiment surveys. These also reflect economic activity. We have manufacturing surveys. So a lot of goods are manufactured, meaning this. You have a raw material, the raw material goes through some form of processing, and then you produce a final product, and the final product has more value added than the initial raw material. This good that would have undergone some form of processing, most likely it is a manufactured good. So examples of this is like you can have agro-processing. So let's say we have oranges, raw oranges. We process the oranges and make juice. This is a agro-processed product. So we have orange juice. Occur in textiles. So let's say we take cloth, we process the cloth and we make clothes. We can take, let's say, leather. We can process the leather and make, let's say, shoes and hats and so forth. So this is possible. This is the manufacturing sector. Surveys, this indicate whether or not there's an increase in commerce or economic activity with the manufacturing sector. We have the consumer confidence surveys. What these reflect people purchasing power, purchasing habits. In a sense, it shows that if consumption is increasing or decreasing. Generally speaking, if consumption is increasing, that is a sign of good commerce in a country. That means that in terms of demand, effective demand, people are finding some way to get money to purchase the goods and services that they want. So increasing demand is good, because if there is an increase in demand, it will send a signal to firms to produce more goods and sell these goods to consumers. Another statistic we can look at is housing data sales and construction. Generally speaking, if there's an increase in housing data sales, in housing sales, so if it is people are buying more houses, or if there's an increase in construction, This suggests an increase in economic activity, and this is good news for the economy. This could also be used as a signal of the forex of a country might increase. And we can have here, the final measure I have here is the trade balance. The trade balance, or the balance on trade, is the difference between exports and imports, meaning this, that if a country produces and exports more exports than before, then every time it exports more products, it earns more foreign exchange. And if it earns more foreign exchange on a freely floated exchange rate, this can allow that country's currency to appreciate or rise in value against other countries' currency. Likewise, the reverse can occur, meaning this, that if a country has an increase in imports relative to exports, then its balance of trade can become worse or worsen. Then there can be a decline in the inflow of the country's foreign currency or reserves of foreign currency. And if this occurs, this places pressure for that country to depreciate its currency on a freely floated exchange rate market. This might sound very technical, but it is not all as technical as it sounds. All this really means is that if countries doing good, if they're exporting more, then it means that they could get more reserves of foreign currency, and it can cause their foreign exchange to go up. Likewise, if the country is doing bad, or if the country is importing more, it can cause the reserves of foreign exchange to go down, and it can cause pressure for the currency or the forex for that currency pair, for that country relative to other countries. It can cause the forex to go down. That's all it really means. So I have here tables, and these tables generally show the relation between the various economic variables and the impact it can have on a forex. So you can read it here. You have interest rates. What is the impact? You have inflation and the impact. So I'm not going to read it out here, but I actually spoke about it just now there, but I'll let you see it and read it out. Employment and the impact. Economic growth and its impact. Retail sales, its impact. Industrial production, impact. Trade balance and its impact. And the last three things here: manufacturing sector surveys, consumer confidence surveys, and housing data surveys. All these three things show economic activity. Generally speaking, improvements or increases in economic activity can send a signal to speculators that the economy is doing well, and this can send a signal to the traders that the currency may appreciate, and the reverse can also occur. So if you've seen a decline in manufacturing activity, consumer confidence or consumer consumption, and housing data sales and so forth, this can suggest that the economy is performing poorly. And if the economy is performing poorly, this can send a signal to retail traders and speculators that that country's currency may decline, and they might start to sell and short that currency, and that can actually cause the currency to decline. So when you're trading currency pairs, you should pay attention to the news, and you should pay attention to the news from the US. So why flag out the US? Why flag out the United States? Well, I mean, in real life, there's a lot of politics, there's a lot of international politics, and a lot of people don't like the US. But regardless of that, the reality is the US is a very big economy. They are the largest market in the world. They have a lot of influence in many countries. They have a lot of influence with economic policies and foreign policies and so forth. And not only that, the United States dollar is still the world's reserve currency. So, I mean, the US is just a powerful economy, and its dollar facilitates the transactions of roughly about 90% of the total forex transactions in the entire world. So, I mean, the US is just a big economy and just have a lot of influence. So, I mean, what goes on in the US can affect other countries. That's just a given. So, I mean, yeah, you have some people that don't like the US for various political reasons and so forth. The reality is the US is a big country and they can influence policy, and their country, the economic events in a country can affect their currency, and what affects the US currency can also affect other countries' currency. That is just a given. So when we're looking at the US currency, one of the things that we look at is the non-farm payrolls, NFPs. So you might be asking, what is the NFP? What is the non-farm payrolls? Well, the non-farm payroll is a statistic that is an economic indicator of employment. What it shows is that the number of jobs added, excluded farm employees, government employees, private household employees, and employees of non-profit organizations. So this information usually releases on the first Friday of every month, roughly about 8:30 in the morning. And when this information is released, this usually causes large improvements or large changes in different currencies that are pegged or related to, let's say, the US dollar, meaning this, that if the non-farm payrolls information comes out and it shows that improvement in labor statistics, employment, and so forth, so if it suggests that there's an increase in jobs and the labor sector is performing well in the US economy, this can send a signal that the US dollar will appreciate. And if the US dollar will appreciate, then it means that it will appreciate against other countries' currencies, so that other countries' currencies will depreciate relative to the US on a freely floated exchange rate. So this data is released monthly, every month, by the Bureau of Labor Statistics. This is an indicator of American employment. And it affects these currency pairs: the Euro USD, the USD JPY, the GBP USD, the AUD USD, the USD CHF. These are just majors. It instantly affect these currency pairs, but will also affect other currency pairs because, I mean, the US is just a major economy. So there are different ways to trade in news. One of the ways to trade in news is to have a directional bias. Directional bias is where you have an idea about where the market can go, and you're just waiting for the correct news to verify that the market might move in that direction, and then you can take the trade in that particular direction. Or you can have a non-directional bias, meaning this, that you do not know which direction the market may go. And once you correctly interpret the news, then you can take the correct position. So if you expect the market to go up, you can take a position where it is you go long, which means to buy. And if you go long on that asset, and if you're correct about the direction and goes up, then you obviously can make a profit. Likewise, if it is now, you suspect that the market might go down and you take a short position, meaning that you sell. If the market actually goes down based on what you saw in the news, you read the news report and so forth, then you can make a profit by being in the right direction. So we have expectations. Now, expectations is very simple to interpret in the sense that when economic reports comes out, if it is now the data actually looks better than what we expected, that suggests that the price of the asset, in this case, the asset we're looking at is forex. It suggests the price of the asset may go up, the forex might appreciate. So in the example with labor, if it is, we see now more people have jobs than expected, then this can cause the forex to go up. Let's say we're not looking at labor. Let's say we're looking at trade. Let's say information comes out of the balance of trade, and assume some report comes out and suggests that trade is actually better than expected. The country is exporting more goods and services than was expected. So there's a more favorable balance of trade than expected. This information would cause the currency to appreciate on the international market. Likewise, if the news was worse than expected, so like let's say the employment was worse than expected, or let's say the trade was worse than expected, this will cause that currency to depreciate. So this is the end of this lecture right here. So I'm ending the lecture here. But the only thing I want to mention, so all of this lecture was about news. Essentially, what we was doing is fundamental analysis, because fundamental analysis is where we look at economic factors. We look at different economic reports. We looked at political reports. We look at foreign policy. We looked at even the things like social factors and how they may affect economic variables or how they may affect our countries and so forth. Because the traders and speculators look at these reports, and when we look at these reports, they give us an idea about the direction of the market. And once we trade based on this information, this information will come out through news. Once we trade based on this information, we will be engaging in a practice called fundamental analysis. So I will bring this lecture to an end here. Stay tuned for more.